Okay, let's talk about bonds. Many of you requesting a focus on bonds. We've focused on stocks, so let's talk about bonds. There has been significant turmoil in the bond market this year. Normally, bonds are pretty boring, but this is a good time to talk about them. Now, if you think back to my asset allocation video, when I showed you my total asset allocation, I had, most money was in stocks and then real estate and all these different things. And then I had bonds. I think it was like 11% of my total portfolio was bonds. What is a bond? A bond is a debt security. It's basically an IOU. Bonds can be issued by federal, local governments. They can be issued by corporations. They can be essentially issued by anybody who wants to raise money. And you go to the public and you say, hey, if you give me some money to build a business or to finance a war or whatever, I will give you a predictable return. Often that return is 1 or 2%. The riskier the bond, the higher the return, assuming that you don't default on the bond. So I can give you an example. You could imagine that, listen, I could issue a bond on the David Pakman show. Okay. Let's say we want to do a project where we do $1 million in bonds at 3.5%. The idea would be I get all these different people to give me little slices of this $1 million. Here's a little slice, and here's another slice, and here's another slice. And in total, this adds up to $1 million. Everybody makes 3.5% per year. So the person who gives me 100K makes $3,500 that year. Usually these are paid out as what are called coupon payments. They can be quarterly, they can be monthly. It doesn't really matter. You get that amount. And the idea is I take my $1 million and I'm making the bet that I can do better than 3%, right? Maybe I take my $1 million and I build a factory, and that factory starts generating, $500,000 per year. And so out of that $500,000, I start making the coupon payments on the bond, but I'm making profit off of this factory that I built. And, after 10 years, I have made the 5 million, I've paid back the 1 million plus the interest, and I come out ahead and everybody wins. Okay, so that's the general idea of a bond. Why would you invest in a bond if, like many government bonds, you only make 1% or 2%, and things are going haywire here? Well, the reason you would accept a 1% bond rather than going into the stock market at 7% is less volatility. So if you imagine a chart for this, if you're in an individual bond and it's making 1%, here's your return, right? It's very low, but it's 1% per year. Whereas with stocks, it will average out over time to 7%, but you could have some crazy ups and downs. Okay, so there's less volatility. There's also an income stream, which is appealing to some. Whereas with stocks, yes, there are dividends, but it's generally thought of that with stocks, in order to take money out, you're selling shares. With the bonds, there's that coupon payment, so it's income generating. Now, what about the reliability of the bonds? Let's talk about that. There are all sorts of grading. There's grading that takes place for bonds, and the grade essentially represents how reliable is it that you're going to get the principal back. U.S. government bonds are considered very, very reliable. The U.S. has never failed. They've never defaulted on their bond debt. Because it's so reliable, you tend to earn a lower interest rate on bonds. Then there are what are called junk bonds, very, very high risk bonds. The rates are often much higher, but the risk of default is also significantly higher. The other thing that's really important to understand about bonds is that you can trade bonds. It doesn't have to be that you buy, let's call it $1,000 2% 10-year bond, which generates $20 per year. You don't have to buy it and keep it for the full 10 years, but the value of the bond can change. And this is an important thing to understand. When the bond declines, rather, let's put it a different way. When the interest rate goes up, the value of the bond tends to decline. There's an inverse relationship. Bonds tend to go down in value when rates go up, and bonds tend to go up in value when rates go down. Why is that? Rising interest rates make newly issued bonds more appealing because they will come with a higher rate of interest. So to sell an older bond at a lower rate, you might have to sell it at a discount. Bonds are constantly repriced. So let's call this January of 23. There's this bond available. You buy it. Great. That $1,000 is now generating $20 a year in payments. But imagine that by July of 2023, rates have gone up. And so now your $1,000 bond has a 3% coupon, 10 years. It now generates $30 per year. Well, if I want to sell this bond, why would someone give me $1,000 for a 2% bond when for $1,000 they can get a 3% bond? Well, what happens then? I might have to lower the price of this bond. There's an actual formula to figure out what it is, but let's just imagine that it's $950. Now, in order to get this 2% rate, because it's a lower rate, I have to be willing to sell this bond for less. Now, if it's been 6 months, I've already collected $10 from my $20 per year. So by selling it for $950, instead of being a $50 loss, I also made $10 on it already. So I'm basically coming out $40 behind. But now I can take my $950 and maybe get this 3% bond. That's the gist of it. Right now, we're in a high rate environment. All year, countries, including the United States, have been raising rates on bonds because rates have been going up. Remember, as rates go up, the value of the bonds goes down. And so those in bond funds have really gotten crushed. In fact, I recently looked at one of my bond funds that I'm in. I forget which one. My bond fund is down 16% year to date. That's as of like mid-October. Why is this? Well, a bond fund is much like a stock fund. It buys a ton of different bonds. As a general rule, when rates go up, the value of the bonds goes down, meaning that because we've been in this high interest rate environment, the bond funds have lost value. Reminder, you should be investing in bonds based on an overriding asset allocation based on your risk tolerance and your age and other factors. The asset allocation you choose should not be based on the environment over the last 6 months. Remember that over a long period of time, returns tend to kind of drift back, reversion to the mean, to their historical averages. So in my case, I believe it's about 11% of my total portfolio. Pick the asset allocation that makes sense. Am I worried about this right here? No, I'm really not. I just keep buying. Now I'm getting the shares of my bond fund at a discount. When the market normalizes, it's all going to come out in the wash.